Not about what you can have next week or next year. It's about what you're going to do with this money in 20, 30 years from now. I see my income growing every single year and sometimes every single month. Now, a year later, I'm making $9,000 a month. It is addictive, that's for sure. Like once you start getting these distributions, it's addictive.
Welcome back to another go-round worth of Masters of the Market. This week, I couldn't be more excited to have Paul Santori on with me from Blossom, who's generating just a little over $9,000 in monthly income there. So if you're looking to rev it up, Paul has a strategy for you. Paul, I want to welcome you to Masters of the Market and just toss you the first question, which is, what exactly is your story and how'd you get to where you are today?
First of all, like I was saying off camera, I really appreciate you inviting me to come out and be on your channel. I'm from Canada, as you know, 51 years old, gonna be 52 in August. Typical Canadian, started out with my RSPs, which is a registered account in Canada, back when I was 18, 19 years old. And at that time, everybody was buying mutual funds, right? It was the easiest thing to get into, the most affordable, and that's kind of what all companies were pushing, and they still do. So that's where I started. Fast forward to 2020. I sat down with my financial planner. I had a whopping $131,000 in my combined portfolios. And, we made a couple of decisions. I moved a little money into a high interest savings account because I thought I need an emergency fund. So we did that. Talked about some of my other positions in my portfolio where it was just mutual funds. And, we went about our ways, right? As you know, a month later, COVID hit and the market crashed. Completely tanked. And I thought, I think this is the best time for me to get into the stock market. No more mutual funds, no more financial planners. I'm going to take the ball and I'm going to do it all on my own, right? So I called up my bank, put in my request to open my own brokerage account. It took a few weeks, but by April 6th, I was buying my first stocks. And like everybody else, I turned to YouTube. I found some guys like, I don't know if you've heard of Dan Kent from Stock Trades. Got a great financial channel and a business in Canada. There's a young guy named Robin that I follow. And of course, everybody knows the GOAT, Adrian from Passive Income Investing, right? I found him in 2020. He had about 300 subscribers. And I think now he's about 110,000. Followed these guys, bought some stocks, and by June of 2020, I made $86 in dividends, right? So I was roaring, I was going. But, a year later, I was up to 981 in dividends. And I was basically buying a lot of the typical dividend stocks that people buy. I found out about REITs, so I started buying some REITs and learned about split corps. I don't know if they have those in the States, but in Canada, split corps, they pay a decent, 10 to 20% yield. As 2022 hit, I kind of got caught in that trap of buying some small cap stocks. Lost my shirt on all of those, so that obviously was not working. They all seemed to go to zero. I played the meme stock game for a little while. Got into some of those, made some money, lost some money. So that wasn't working. But by about 2023, I really started getting into the covered call ETFs. And in the last 2-3 years, the providers in Canada and the States have just been pumping them out, as you know, right? They're just, every week there seems to be a new one. I basically started picking up ones that were being recommended online by Adriano or other YouTubers, collecting the dividends, and just each month reinvesting the dividends and growing it, So I sat down and I thought, okay, I'm talking to Ari. I got to have some numbers for him. And from 2021 to 2022, my dividends increased by 75%. A year later, went up by 45%. By 2024, another 93%. I was making $5,000 a month. So I got to the point where I surpassed my take-home pay, right? So if I lost my job, I'd probably be okay. The money was coming in. Now, a year later, June of this month, as you said, I'm making $9,000 a month. So there are a lot of people who talk badly about this sort of strategy, income investing or covered call ETFs, but I see my income growing every single year and sometimes every single month. So to me, it seems like it's a strategy that's going to work.
There's so many stories like yours, Adriano's, and everybody who's doing this, I want to say, new trendy investment strategy of passive income investing. Everybody seems to have started with dividend stocks, the traditional dividend stocks. I just want to ask you off the bat, is that like a dying strategy, you think, the traditional route of dividend investing? And should we all be veering into more of the covered call income investing strategy?
I don't think it's necessarily a dying strategy. I think a lot of it has to do with what works for you, and also your age. If you're younger and you have more time for a dividend growth strategy where, a stock might have a 2% yield, but it grows that yield by 10, 15% a year, then, 20, 30 years down the road, it's going to make sense. But, I don't want to wait 20 more years to retire. So for me, I'll give you an example. I started with Enbridge stock, which paid, say, a 5% dividend yield. Then I found out about the split corp, ENB. Anyways, I bought that one, and it paid, say, 10 or 12%, okay, which was fantastic compared to the 5%. Then, Global X came out with a fund that pays 18%, but it holds oil stocks as well. So I just went from one to the next, and each time your monthly income just grows. That's the way I see it. I wouldn't say, though, that the dividend growth strategy is dying. It's a different way of doing it.
To say, it's almost a time and a place for that type of strategy. And you already mentioned it. If you're younger and you're in the position to invest in more dividend growth oriented opportunities, that's what you should be doing. However, the fad today really is this new passive income investing strategy. So what would you say to the masses of younger investors who are leaning into this strategy? Would you tell them, hey, you got to stay in your lane and go more growth right now? Or would you say it's quite all right to go down this path and start generating that passive income for yourself now, even though you might not need it?
A real life example would be my kids. My son specifically, he's like me. He loves this stuff. My daughter, not so much. And what I did with him was I started him off with some of these covered call ETFs so he could see the monthly income. Once kids see that they're making money, they kind of get addicted to it. And then once he got a bit of a portfolio growing and making a monthly income, put him into a growth fund. And now the goal is to make that probably 50, 60% of his portfolio. I think for a younger person, you can be a hybrid investor as well.
So let me ask you this. With that being said, what's the best way then to go about finding your investor profile? It's something that I speak about quite often on my channel, really understanding where you stand as an investor, whether that's your risk tolerance, your age, your goals. How would you help an individual discover their investor profile? What are some of the keys there to do so?
That's a good question, Ari, and you mentioned some of them. When people send me messages on Blossom and they ask me, what should I buy? Well, it's not just as simple as what should you buy, right? Because it's, how old are you? How much money do you have? What's your risk tolerance? If you put your money into one of these covered call ETFs and it drops 20% tomorrow, are you going to be upset about it? And then depending on how they answer those questions, I try to give them some suggestions on. And for some people, the suggestion is just buy VFV, or buy VU. It's not for everybody. Like the covered call ETF strategy is definitely not for everybody.
So with that being said, who do you think these covered call strategies, or these ETFs rather, are for? Like the ideal investor, who should be looking into them?
Somebody, I guess, who's more hyper-focused on growing their monthly income. And I guess leaning towards somebody who's a little bit older. You don't need the income when you're younger, but as you get to be a little bit older, you want to start thinking about retiring, then that would be, I guess, the person that these would work best for.
Do you need to watch these ETFs pretty carefully in your experience, or has it been pretty hands-off for you?
I think these ETFs, you can buy them and just kind of put them on drip and let them do their thing. Or, maybe if you want to check your portfolio once a week or once a month, you can do that. Because this is a real big hobby for me, I check my portfolio daily. But I have friends that have gotten into this who, maybe once a month, they'll check and see where things are at, and they'll take their dividends and reinvest into something that's on sale at the time. So it really depends, I think, on your personality. Some people are very active with their investments, and other people, they don't want to be, but you don't have to be.
Here's the question that I have, especially we can even bring up Adriano. He was on the channel actually almost a year ago now. From when he was on to now speaking to you, and you guys are using the same strategy. Like I said, there's this big push to generate the passive income, and almost no longer the necessity or the need or the interest, rather, for a lot of these younger investors to tap into growth, whether it's a fund or an individual stock. But there's got to be some risks involved with some of these funds. And I'm curious to know, in order to be that hands-off, almost ultra safe or as safe as you can be investor, what are some of the red flags that we should be looking for when we're looking into these types of funds?
If you want to keep your portfolio, say, to a minimum, maybe low to medium risk, you want to stay away from, like your yield max type ETFs where they're using synthetic shares and they're writing on 100% of the portfolio and they can swing, 50, 60% in a couple of days, right? You want to go for the ETFs that are covering an index like the S&P 500, pay a 10 or 11% dividend yield, but they're pretty level. They'll go up and down with the S&P, but they're not going to drop 40, 50% in the course of a week. But they're also not going to pay you that, crazy 100% yield.
Are these volatile indexes or ETFs where the money is really made, or can you actually make, where you're invested now? Is that where you're making the large sums, just investing into these indexes?
No. In Canada, we have a company called Harvest that in the last 6 months, maybe 8 months, they came out with sort of a Canadian version of the yield max funds where they'll take like a Coinbase or a Strategy and they will do a single stock ETF, but they actually hold the underlying stock and they'll only write calls on, say, 33% of it. So the balance you have, the shares are there just to grow. And what they do is they kind of have a more fixed distribution and they keep it lower. They're not trying to give you the 100, 130% yields. Maybe it's 15, 20, 25, 30, but they seem to be a lot more consistent. And it's been a game changer, to be honest with you.
Interesting to me, I'm even just now thinking about Adriano's conversation when I had it with him and, where you're at now generating $9,000 in income monthly, which is surpassing your career, your full-time job. And it just creates the question. It's like, well, why not everybody, why isn't everybody doing this? Where are people perhaps going wrong then with some of these funds, and why shouldn't everybody be investing like this?
I don't think necessarily people are going wrong, or why isn't everybody doing it? Why didn't I invest in VU 15 years ago? I could have made a pile of money, but I didn't know about it, right? I didn't know that that's what people were doing, investing in the S&P 500, right? Because I was uneducated about it. So I think that's it. Like, a lot of people, maybe they just don't know. It's hard to say, Ari. I don't really have the answers for that, to be honest with you. A lot of people say, why doesn't Warren Buffett do it? Well, Warren Buffett's a billionaire. You know what I mean? He doesn't just buy stocks. He owns businesses. He's at a whole other level than we are. So, I can't go out and buy all of Dairy Queen. He owns it. I don't think really there's one right answer for investing. A lot of it depends on you personally as well, right?
Absolutely. I'm thinking 10 years ago, 15 years ago, these vehicles were not even around. And so they are very new still to the retail investor, just getting our hands on them, being able to make money. Like I said, I interviewed Adriano about a year ago, and when you started following him, he was around 300 subscribers. Now he's over 100,000. And it just goes to show, look, with all the education, with all the information coming out, and the kind of trend is your friend train leaving here, everybody wants a piece and to jump on. Where do you think, in terms of the market, where are we heading with these ETFs? Is this the future?
I'm not sure what's coming out next. A lot of these providers are trying to do things to make the investors happy, which I don't think used to happen. Now because of social media, because of YouTube, fund managers are being interviewed by guys like you, and they're realizing, what do people like me want? So I've watched videos now. I think his name's Spencer, where he talks about how you can get paid every day of the week. Right? If you buy certain funds, you can get a dividend on Monday, Tuesday, right through to Friday. Do you really need that 5 days a week? Probably not, but that seems to be where it's going. Is these companies are trying to meet the needs of the people. Some of it's a little bit silly, I guess, in a way, but it is addictive. That's for sure. Once you start getting these distributions, it's addictive.
I was gonna say, I used to call it, when it came to dividends, dividend dopamine, and it was just like, okay, how do I get that yield up? How do I get that next dividend? And even when I first started out as an investor, initially I was in a index fund, and that was I just put, I think, $20,000 into the account and let it sit for a while. And then I really started to get into the game of investing through dividends. And again, it was like that same effect. It was like, oh, I loved watching the dividends hit my account. I eventually had to ask myself some deeper questions. What am I doing as an investor? What are my goals? How am I going to get there? And where am I, based on my profile? I started to veer into dividend growth investing, heavy emphasis on the growth. But I'm sitting here thinking now, to compete with the kind of dopamine hits of the distributions at 10+%, 20%, it's almost impossible. How would you recommend investors, especially the young investors out there, put aside their emotions and stay their course to be level-headed?
For me, the distributions are great, but I think that the important thing is you have to see it growing, right? So if you're a growth investor and your goal is to have $3 million and live off of 4%, you know what I mean? So you have to see your portfolio growing, not week to week or month to month, but decades. For me, I'm not really trying to get to that $1 million, $2 million portfolio, but I have to see my monthly growing, right? There has to be like a goal. You have to have goals, you know what I mean? And you have to work towards them. And that's what I'm trying to teach my kids is you're 20 years old now. Would you like to be able to retire at 40 or 45? So if you would, you have to work hard, and then you have to take a portion of your income and put it in your account. And my son says, yeah, great, next year I'll buy a car. No, you're not gonna buy a car, right? That's not what you're investing the money for. You're investing the money for your future. You know what I mean? It's not about what you can have next week or next year. It's about what you're going to do with this money in 20, 30 years from now when you decided, I don't want to work anymore, I want to travel the world, and now you have that opportunity. I mean, for young people, I guess it's harder to see that far down the road, but that's the goal, right?
Definitely it's harder to look down the road. I have these conversations all the time. Hey, if you can look 10 years out, 15 years out, 20 years out, you're going to be in a great position. Yeah. But so few people are actually able to do that, and I'm curious to get your perspective on that. Why?
I guess people just live for the moment, they want to have flashy things. They want to have, nice clothes and a nice car. And, they're more concerned about what people think of them today as opposed to, saving up for their future and, and having security of being able to take care of yourself without relying on a job, I guess it's important to some people, especially younger people. I guess it's more difficult with social media nowadays, to try and live up to other people's standards, which it's ridiculous, right? It doesn't matter what you wear or what you drive, it's if you have the money in the bank account that you can take care of yourself, that's what matters.
This is kind of a tie-in question, but when people watch Adriano or people even on Blossom, I mean, you got quite a following on Blossom, which, by the way, if you're not already following Paul on Blossom, definitely someone to follow, really learn his strategy, how he's building these income streams. But okay, let's say people are following you, and again, those emotions come in, and it's that dividend or distribution dopamine hitting them. But they have to remain calm almost and say, you know what, Paul's story is different than my story. Adriano's story is different than my story. It's almost too hard to do nowadays when you're watching somebody else generate all that income. So can we train patience? Is this something that we can work on, that you think is feasible for all of us to work on?
Yeah, I think so. And did you interview Perry or did somebody else interview Perry?
I also interviewed Perry.
Yeah, so I mean, look at Perry. He's making $40,000 a month, and compared to what I'm making, that's incredible. When I first started watching Adriano, and he was making $4,000 or $5,000 a month, and I was making $100, it was like, well, I'll never get to where he's at. But you keep working at it, and now I'm past where he was when I first started watching him. So now he's making 20, 30,000 and Perry's making 40. Oh, maybe I'll get there. You know what I mean? So you kind of have to have the patience, like you said. And but I think these people are inspirational, right? It's an inspiration to see, okay, somebody else has done it. Maybe I can do it as well.
When you look at some of these other portfolios, whether it's Perry's or Adriano's, do you have your own strategy to say, hey, you should only have X amount of funds in there, or perhaps you should have X amount in growth, Y amount in income orientation? I'm curious to get your scope on building out a portfolio.
Well, like when I first started watching Adriano, he probably had 80 to 100 positions in his portfolio. And currently, I think he's down to about 7, maybe 8, right? So, it's been a big change in the last 5 years on how he's done things. And myself, I was looking at it, and I think in the last few years, I've sold over 60 positions. That I've bought some, sold some, bought other ones, sold other ones. And I'm actually trying to take a bit of a play from your book and reduce the number of positions I have, because do I really need 50? Right? Do I really need 40? I'm finally down to 35, and I'm trying to, instead of having these little tiny positions that pay you, a couple bucks a month or whatever, I'd rather have larger positions, that are more focused and pay better. The problem is they keep coming out with new ones. There seems to always be something new coming out, and you want to try it. So, I sell one and I end up buying 3 more, but I am trying to get more focused, you know what I mean, and have better quality. And at the same time now, what I'm trying to do is use some of the high yield dividend funds I have to buy things like SCHD. Go for the ones that are maybe more conservative, but will grow over time, kind of like a safety net, a little bit of an emergency fund, right? So I'm trying to do that as well now, and I'm even starting to set aside some cash. I'm starting to work on, like, what do they call it, the 3 bucket system, where you have one bucket where you can use that for spending money. When I finally decide to pull the plug and retire, I'll have cash to live off of for the first, couple of months, and then keep funneling money from my distributions into that bucket. So I'm starting to work on these things as well now. I'm kind of like expanding my portfolio.
Let's say someone out there right now watching us and saying, wow, Paul is generating income and I'm almost at zero, or I don't know, a couple $100 and just plain old dividend income, and they want to switch their portfolio to be more aligned with your strategy. How would you recommend that these investors reorient themselves to actually follow suit on a strategy like yours?
What I like to suggest to people is start small, right? Like if you've never bought covered call ETFs and you just have maybe a growth fund like VU, or you have some individual stocks like Johnson & Johnson or whatever, maybe dip your toe in and buy a covered call ETF. Start with 10 shares, maybe start with 100 shares depending on the size of your portfolio, and wait a month, wait until the first distribution hits and you kind of see how it works, and then buy a little bit more and kind of ease into it. I wouldn't recommend somebody go out and just buy, $100,000 worth of ETFs on the first day, because if it doesn't go the way they want it to, then they're going to be upset about it, right? And they might not fully understand how it works in the beginning. So it's probably better to ease into it slowly and do some research. I tell people, go on YouTube, watch some videos, learn what these things are about before you just take my word for it and go buy them. You're either going to like it or you're not, right? And once you kind of learn how it works and you see the money coming in, then you can decide. That's what I did. I held on to TD stock right up until I think a month ago or 2 months ago, and then finally I sold it and I put it all into a Canadian ETF called Bank. So I still own TD Bank, but I just own it in an ETF, and I get an 18% dividend.
Should we all really just be focusing on ETFs at this point? Because I was even at an ETF conference not too long ago, and we're just at a point where ETFs are overtaking the amount of individual stocks. We know for a fact that no investor, including Warren Buffett and the other greats out there, can perfectly time the market and pick the winners 100% of the time. But ETFs are kind of your golden ticket to wealth. So what's the point, these days, of even trying to pick those winners and find individual stocks?
If you can do it, if you can pick the right individual stocks, you're going to outperform, right? You're going to outperform ETFs. If you had jumped into something like Nvidia 2 years ago, when whatever it was at $100 at the time, and it shot up to $800 or $900 in a year or two, you're going to make a lot of money. But you have to be able to pick those stocks, and I don't feel confident in my abilities to do that. So I don't even try. I don't analyze balance sheets and income statements. I don't do all that stuff. But if you can, then yeah, sure, why not? If you can do it. Who's Daniel Pronk? You ever watch Daniel Pronk's videos? He's great at picking stocks. You also have the patience. I think you have to have the patience for it, because some of those stocks may not, you may not see the results for years at a time. So if you have the patience that you believe in a stock and you can do that, then I would recommend it to people who are capable of doing it. But I think the average person is probably not.
I agree with you. There's so many investors, I think, trying to do just that. And, sometimes we fall flat on our face empty
Yeah.
pockets at that point in time, saying, why didn't I just pick something that, would have yielded me this return? Now, you mentioned a moment ago when we were talking about, starting slow, which is also, again, something I agree with. Start slow when you're investing. Build up these positions. See if you're comfortable with them. See if you like them. What do you dislike about them? I'm curious to get your opinion on, when it comes to income-oriented funds, what would be some of the things that as investors we may not like about those funds? Like, I'm just trying to think in my head, well, I see Adriano making all this money and again, Perry and you, and I'm like, why not me? And so I start to throw my money into these income-oriented funds, but what would be one or two things that may sway me in the other direction?
If you buy funds at certain points in time, like where maybe they're kind of at a high, and so you decide, okay, I really like this fund, it pays well, it's $15 a share, I'll buy 1,000 shares. And a week from now, something happens in the market and all of a sudden it drops down to, maybe 11 or 12 bucks a share. You might be looking at your portfolio going, wow, I'm making 200 bucks a month in dividends, but I've lost $3,000 in equity, and so you might think, well, this sucks. I don't really, I don't like this type of investing. But it's really, when you think about it, it's really no different than if you were to go and buy Visa stock and something happens in the market and the share price drops by 40, 50 bucks a share. At that moment, you're losing money, but only if you sell, right? And it's the same thing with the covered call ETFs. You may be down for a little while in terms of your share price, but if you hold it long enough, chances are it will come back up. Or you can do like you do with any other stock and just buy more, just DCA while it's down.
Do you find the vast majority of investors who are buying up the covered call ETFs have a little bit more emotions when those stocks or funds rather are swinging low?
It depends on the person, right? Because there are a lot of us who have been sort of in this investing style in this community for years now, and it's like a big sale. You know what I mean? It's like the market's red, prices have dropped. It's like I've been sitting on 20 grand and now I'm going to go shopping, and they get excited, right? Like they're really excited about it. But if you haven't been in the market doing this type of investing for a while, then you see the prices drop, you might think, well, great, I've just lost all this money. So it's kind of all in your mindset. You have to understand the strategy, and you have to understand the fact that the market goes up and down all the time, almost for no reason whatsoever, right? It's very emotionally based. So you almost have to take advantage of other people's emotions, right? Other people are selling because Donald Trump said this, or a war started somewhere here and the market tanks. That's when income investors are buying.
Can you talk to us a bit about erosion? Because the word erosion's thrown around quite a lot when it comes to these funds, and I think this is almost a primary driver of why people stray away from these funds or have a negative connotation or association with them.
Yeah, it's an interesting topic, and to be honest with you, I don't fully understand it. They say that these ETFs are only paying you back your own money, that there's NAV erosion, that every time you get a distribution, the share price is going to go down. And then I look at a fund like launched at just under 13 bucks a share, and now it's well over $22 a share. Where's the NAV erosion? How come all the distributions they're paying is not eroding the fund, right? I'm up like 60% or something. I'm debating on whether I should sell it. You know what I mean? Is it too good to be true? But yeah, so they basically just they seem to go up and down with the underlying stock, right? If the underlying stock is doing well, then you get share appreciation. If it's not doing well, then it goes down. But I haven't really seen any correlation to they're paying me a distribution, so the price goes down.
I almost feel like that comes down to your ability then to pick a fund that has a good quality underlying position. How would you recommend investors find those positions?
I think the best thing to do is just to be as diversified as you can in terms of, for one, picking different fund providers, right? I wouldn't want to buy all of my ETFs from just one provider, right? Because each one has different strategies. And some outperform others a little bit here and there, but yeah, I wouldn't want it to be all with one. And you can go for different markets. Like I have ETFs that focus on banks. I have ETFs that focus on utilities, on oil. You can get some that focus on the S&P 500, the NASDAQ. So I think that's the best way to go. And also there are funds who they target like maybe a 10% yield. They target a 12% yield. Some target a 20% yield. So, you kind of spread it out and take a little bit of each.
So the idea of diversification, I mean, this is also interesting to talk about now when it comes to funds, because naturally people think about, oh, I'm invested into a fund, I'm already diversified, and I can have more of a consolidated portfolio. Now, you had even mentioned earlier that Adriano consolidated, now he's down to, I think you said 7 holdings. This idea of diversification, though, to touch on just one more time here, you would say it's all about diversifying in terms of the providers?
That's one way to diversify, right? By provider, also by country, right? You can have ETFs that focus on Canadian stocks, American stocks, right? Global stocks. So there's lots of ways that you can diversify. And I also think, like, for somebody like Perry and Adriano who have portfolios in, say excess of $1 million, they can go for maybe less positions, maybe lower yields and still generate a lot of income. Where with a smaller portfolio like mine, I'm willing to take a little bit more risk on some single stock ETFs to try to squeeze out more income from a smaller portfolio.
Are you worried at all about taxes when it comes to the income that you're receiving?
I'm not worried about the taxes because I guess about 90% of my portfolio is in tax advantaged accounts. So there's no taxes. The one account there is taxes, but only when you start withdrawing the money. Basically, it's like you're getting an income, so you have to pay tax on it. When I get my distributions every month, I don't pay tax.
So in which case, a lot of investors would want that money, especially if you're younger, you're going to want that money now. But I agree with you, you should be playing the game of taxes, and if you're heavily invested into these funds, certainly tuck money away into tax advantage accounts. Should there just be anything we should be looking for? Again, for the younger investors who are out there who think that this is kind of like the get rich quick or have my money in my pocket by Tuesday crowd, what would you say to them that's like, hey, you got to keep your eyes on this because taxes are going to come out? A guy like Adriano retiring early, I mean, again, you got to think about taxes.
Yeah. Well, and Adriano has openly admitted that he's retired from his 9-to-5 job, right? He doesn't have a boss anymore. But he's probably one of the busiest guys I know, right? He's pumping out videos, it seems like almost daily now. He also does one-on-one consultations. So he's actually running a very successful business, right? He's not just sitting on the beach, drinking rum and cokes and relaxing. For anybody who thinks this is a get-rich-quick scheme, I don't think so. If you have a couple $1 million and you throw it into these ETFs, sure. I guess by next week you could be pulling in a lot of money. But if you're starting out small, like I said, it's taken me 5 years to get to where I'm at. And the first few years it's very slow. And you start off slow, but then once the snowball effect kicks in, then it grows fast.
When I think about why I started dividend investing, it was the snowball effect that kind of kept me on the dividend hamster wheel of, okay, just put more in, drip the dividends, and I'm going to see more. I just see these funds and where they're at today, and it's crazy to just see how much income is being generated. It almost emotionally makes me want to start some of these positions up. Just hearing, you're bringing in $5,000 to $9,000 a month. Perry's over at $40,000 a month. They're crazy numbers, and it almost seems too good to be true.
And technically, if I had taken my $130,000 5 years ago and put it into the right stocks and maybe Bitcoin, maybe I could be sitting on $1 million today, which would be too good to be true. Again, I would have had to know which investments to buy, right? And when to buy them. And unfortunately, a lot of people have FOMO. They see somebody making a lot of money on a stock, and so they want to get in on it. And then there's a correction in the market, that stock drops 30% and they get upset. So then they sell, so they lose money, right? And then it goes back up again, so they buy again. With these kind of funds, you don't have to really worry about buying and selling them. You just collect the money. So in that way, I think it's a simpler way of investing.
That's the aspect of it that I'm saying it's just sounds way too good to be true. And I'm always trying to find the red flag that we're all perhaps missing. And so far, can't find. As long as you're invested in quality positions, I can't seem to find those red flags. Yeah, I could nitpick the taxes, but if you're invested in these funds and it's in a tax advantage account, that makes sense. Then I look to the younger investor and I say, if these guys want to retire early, they can't have it in the tax advantaged accounts. So is that the red flag?
Can you not do that in the States? You can't have it in a tax advantage accounts and retire early?
You can have, I mean, if you have a tax advantage account, that's great, but it's going to come down to you pulling it out at the age of retirement. And so my whole thought process, like if, Ryan and I always talk about this, I'm heavily invested more in dividend growth and thinking, long term. I don't really have plans to retire early, so to speak. Ryan on the other side, has some plans to retire a little bit earlier. And so therefore he doesn't keep all of his money in tax advantage accounts. But I just think about these high yields that are coming out from these funds.
See, in Canada, our tax-free savings account
income
doesn't really have an age restriction.
There's no age restriction.
No, so like in our tax-free savings account, which has only been around for about maybe 18 or 20 years, it's something newer. They give you an amount every year. They'll say, okay, this year you can put $6,000 into it, right? Next year might be $7,000, whatever. But once you put the money in there, you can take it out whenever you want. If you put in, there was one guy in Canada who actually, he bought a lot of, I think, Shopify when it was really cheap in his tax-free savings account. And he sold it at the peak. He grew his account to like $800,000. But he can withdraw that money at any age. Like he could be 40 and he could take the money out. Tax-free, right? No taxes on it. So if I can get my TFSA where it's paying me $6,000 or $7,000 a month by the time I'm 55, I can pull it out.
I hope all the Americans are listening to that. I don't know if we want, for those Americans who are saying Canada should be the 51st state, maybe we should just join Canada. I mean, it's even going back to what Adriano was saying, though. I mean, there even seems to be, and I know a lot of these funds started off in Canada, and then the wave kind of came to the U.S. So it's just interesting to see, what's happening in Canada with these funds and the income. I'm wondering, like, are we behind in America?
Well, I mean, you guys definitely have, all the better companies than we do. But it seems like our ETF companies are able to use your stock market to generate income better than you guys are. And a lot of our ETFs have leverage. I don't know if you know this, but a lot of them have 25% leverage, which even boosts the income even more. So that's really what the game changer's been in the last year or two, is these ETFs with leverage. Now, of course, when you have leverage on an ETF, that means the share price is going to go up and down even more. So in a down market, you're going to lose money faster. But again, that's all on paper, right? You're not losing money unless you decide to sell.
And I think that would be something, at least in my mind, that every investor should be well aware of, is when you're looking at the leveraged funds, you have to be cautious because volatility is real. And volatility can certainly trigger emotions. And emotions are what makes you sell at the end of the day. How many volatile positions would you say an investor should get their hands on?
Well, I think you have to build like a base, right? I mean, you have to have a certain percentage of your portfolio that's not volatile. Maybe even if only one of your positions is not volatile, but it's 50% of your portfolio, then that'll cover it. I guess after that, you can have as many volatile ones as you want, whatever you're comfortable with. In terms though, Ari, I know I've seen you and Ryan talk about like sort of like leveraged, like the new, ETF of the week, the fun ones that are 2x and 3x. Those kind of leverage funds I stay away from, right? I don't want that type of leverage where you can sort of like go up 200x or down 2x in a day or whatever. I think that's for like swing trading or traders, right? If you can see the momentum in the market, you buy those, you hold it for a day or two, and then you get out. But the ones that we have with the 25% leverage, it's more modest leverage, right? And it just kind of gives a little bit of a boost. But you're not going to see your whole portfolio drop, 2x or something in a day with that.
Paul, let me ask you this. Is Wall Street getting out of hand?
I don't know. Maybe it's getting out of control. But, I don't have a pension. A lot of people have pensions, right? So their investments are kind of like just to supplement their pension. For me, I don't have a pension. So if I can't build up my portfolio to the point where it replaces my income, then I'll be working forever, right? And not that I don't mind working, it's nice to have the option of not having to work if you don't want to, right? Or at least I'd like to cut back eventually.
Would you say that your strategy now should be the starting point for most investors?
Not if you're young, I guess. If you're a young person in your 20s, then this is probably not the starting point. you'd probably be better off just to put your money in the S&P 500 and let it grow, and then maybe eventually you could transition over or do a combination, be a hybrid investor and focus on the S&P 500, but also have some income, maybe some different growth stocks as well.
So let's take some of these younger investors then that are investing into the S&P, or we'll go even, some of the older investors, they started out, they're investing in the S&P, they're building this foundation or base, if you will. When's the point that we could say, okay, I think I'm ready now at this point to start to shift gears into an income strategy?
I don't know if it's necessarily a certain amount of money, but I guess, if you're thinking about retiring, you're going to want to switch to sort of like a passive income approach, maybe a couple of years out from retirement, because you want to know what you're doing. You want to kind of learn the strategy. I don't know if you've ever watched the Income Armchair, but the host of that channel, he was a real estate agent. He owned, I believe, a lot of property, sold it all. Now he has a portfolio between, I think he sits around 8 to 12%. He buys, what do you guys have in the States, like the BDCs and other stuff like that. And he's been retired for years now. I think at a certain point, you just kind of transition your portfolio, whether that's real estate or growth stocks, and you transfer it into something that's going to provide you income. Unless you want to just hold on to it and sell shares, which is what a lot of people do as well, right? I think that's kind of the old style, but if it works, go for it.
What's the process, at least for you, having planned for retirement? How do you know how much money to put into the market for yourself with these income funds, or do you just keep going?
I mean, I'm young enough that, I don't really necessarily have to think about retiring yet. I'm trying to get to a point where I can cover my bills, right? I like to be able to cover my bills. I want to be able to reinvest. You want to keep growing the portfolio so that you can fight inflation. I'd like to have extra money to, say, travel. I've got 2 kids, right? So you want to have some money, you can help your kids out. So I think for me, the goal is, it sounds ridiculous to me anyways, but I'd almost like to be around $20,000 a month, probably 5 times my income today. So do I really need 5 times the income I'm making now? Maybe not, but that's my goal anyways.
So with that being said, I'm just curious to get your opinion with this. You don't have $1 million portfolio, but yet you're still generating the $5,000 to $9,000 a month. 5 on the lower end and now 9 on the higher end, which is even in and of itself like an incredible feat. I'm just thinking we're all on this race to become millionaires, so to speak, right? I know like my goal is like, all right, the 7-figure club. I can bring on anybody onto this show and it's the same goal, but yet I hear across the board with income investors, it's actually not the goal. The goal is to generate that passive income to be able to live monthly and to heck with the $1 million. So are we fooling ourselves by trying to be on the race to $1 million, at least at this day and age with the funds that we have available to us?
I mean, you're a lot younger than I am. So for you, still trying to get to that $1 million or more club, that's a reasonable goal, right? I'm at the point now where I don't want to spend the next, 10, 15, 20 years trying to get to that point. And this is a way of retiring sooner. So I guess it's a trade-off of, having less money in my portfolio, but having more freedom at a younger age.
It's a lot of firepower. And it certainly gives you the ability then to either retire early or at least pull back, and work less hours. It's almost this added, I want to say, insurance for yourself. Is it worth it to go the route of generating the passive income to retire early?
For me, it's worth it. I mean, I want to have the option to be able to retire, or if something was to happen for me at work where I find myself unemployed, I don't necessarily have a lot of options, right? And I don't have a pension to fall back on. To me, it's worth it. And what I'm doing now, Ari, is a little bit different than the last few years. Is I'm trying to start using my portfolio a bit more, like actually pulling distributions out to see, will it sustain itself? Like, am I going to be able to pull money out of the portfolio, not reinvest it, and still have the portfolio generating that level of income? So I've last month I took out $1,000. which is not a lot, but I took out $1,000. This month I bumped it up to $1,500. I also put $500 aside for cash. I'm working now at seeing, while I'm still working, I'm working on seeing if my portfolio will actually sustain itself in the long run once I retire. Looking at my notes, and April 8th, 2025, my portfolio dropped down to 292 from a high of, it was up at 388, dropped to 292, and now I'm at 407. So for people who say that like covered call ETFs will not recover, they're just going to lose money. How did I go from, 388 to 292 thanks to Trump, right? And then back to 407. They really
I feel like
do
that all
move
comes
the
back
market.
down to that underlying position. As long as it's quality, it seems like you'll be back.
Well, like the last week, tech stocks have done really well, right? Bitcoin's up, MicroStrategy's up, Coinbase is up. I have a lot of money in these type of tech funds, and they're doing well. So as they do well, so do the share prices. And hopefully next month the dividends will be even better.
Were you at all worried when that drop occurred?
No, I've been doing this for so long now. I realized, like you learn from guys like Warren Buffett, you have to be able to stomach the ride, right? It's not as much about what you know, it's about like being able to stomach that volatility.
I love that approach. I love that outlook. I've taken a look at your portfolio, Paul, on Blossom, of course. And again, for every investor out there not familiar with Blossom, it really is a go-to community. So I have a link down there in the description, in the pinned comment. You can find Paul's portfolio on Blossom. Really get a good understanding of how exactly he is generating over $9,000 in passive income, which is incredible. But Paul, I want to say thank you for joining me on Masters of the Market, and most importantly for all the other investors who are out there. Until the next go round of Masters of the Market, we will catch you in the next one.